So my name is Brian Rogers. For those who don't know me, I'm going to be presenting on systemic risk as part of the macro group here. I'm a team leader, so we've worked very hard putting this together. I'd also like to thank Big for letting us open up this semester, and most importantly, thank all of you because you came here to get educated, and that's what the college experience is supposed to be about. Unfortunately, we're moving a little bit away from that in our society. So thank you for coming and educating yourselves, and you could always go to the career fair after. It lasts till 4 o'clock. So I'm going to start with talking about a quote from Janet Yellen. She spoke yesterday, the Fed chairman, testimony to Congress. I hope a lot of you have been able to watch some of it, or at least read some headlines. One quote that she had said was, emerging markets don't pose a substantial risk to the U.S. economic outlook. So we've all seen that there's been a considerable amount of news coming out of Europe, Asia, South America, all these markets over the past couple of years even, and especially the past couple of weeks. But I'm not going to focus on those emerging markets at all. I'm going to focus on the U.S. economic outlook and its fundamental backing and how it can kind of absorb risk and its ability, its health. And first I want to look at the S&P 500. Alan Greenspan once said that the markets are an indication of the economy. So I want to see here, you can see three bull markets where the S&P rose drastically in value. The first was the dot-com bubble, as it's commonly known, and that was in 2000, and there was an assumption that technology companies would grow, and that grow infinitely, at a high rate, and that proved to be false. So then we hit a floor, and then we grew in the financial crisis. This is very more complicated, and there's a lot more to it, but on the assumption that housing prices would increase forever, and there was a lot of interconnectedness, and the markets crashed. So what's happened since then? Since then, we have seen markets increase about 23% annually, and in the past year, 2013, we saw about 26% growth, one of the highest gains in the S&P throughout its history in 1 year. Recently, we've seen some volatility as markets are kind of unsure where we're going. So I'm going to kind of show the assumptions that are currently in place at why we are valuing the S&P 500 at near historic highs. So I'm going to go over the S&P, kind of talk about normal growth, as it's called, the sustainability of our current economy, and I'm going to finish with some monetary policy, and then talking about the banking system. So first, this is a graph of the S&P 500 in real terms. As you can see, with adjusted for inflation, we're still not at the highs from the dot-com bubble. However, what I want to point out is the red line. The red line is the New York Stock Exchange margin depth. This is at all-time highs. So why is this important? Margin. So if I use $10 and say I use margin, I'm 10 times levered, I have $100. If I have a 5% gain, that could create my gain to be 50%. However, it works the other way around. So in markets where they're going up, that's good, because if I get a 5% gain, my capital is up 50%. Hooray. If I have a down year, though, where I'm down 5%, that's 50% wipeout. If I'm down 10%, I'm wiped out. My capital is gone. So what do I need to do? I need to liquidate. It's called margin call. So I need to sell off all my assets. Not only the risky assets that I'm allocated in, but also sometimes my good assets as well. And these forced sell-offs can result in dropping of asset prices quickly, because there's some major players that use this type of leverage. I want to point to the second from the top, Millennium Management. They have net assets of $13 billion, which is a good sum. However, they use $119 billion. So this is an example of 10 times leverage. If their investments move the wrong way, it can cause another margin call. SEC Capital is highlighted because of, I just want to point out that some of these are not the best companies. They just got indicted with insider trading. So it's just kind of showing that there's definitely some dirty play that can be used in these as well. So normal growth, I'm going to talk about fiscal policy, some of the components of that, and then I'm going to try to go through the basis of how earnings are explained and the S&P is valued. So fiscal policy, we all know that we've been running huge deficits since the financial crisis, averaging about $1 trillion a year. This is able to stimulate the economy to get back to normal growth. as it's said. So we've had about 5 years of this now, and we're still not growing at levels that we would like to see. This is a White House Budget Office budget estimate, and I'm going to throw some of these into a graph in the next 2 slides, but I just want to show where I got the numbers from. So this is 2 lines. The blue is the receipts from the government, so that's their taxes. The red line is the outlays, that's their costs, that's their expenses. So you can see that it's projected through 2023 that receipts are expected to rise, tax revenues are expected to rise, and outlays, their costs are expected to rise because things like Social Security are expected to cost more in the future. But the big thing, how are taxes going to rise? They're not planning on raising rates to stifle growth. What this is relying upon is that we hit nominal GDP of 5.5 to 6% between this 2015 period and 2020. And as you can see, if they do that, the green line, which is the deficit, which is on the right, which in 2012 was still at $1 trillion, will drop down to around $500 billion a year. So the government isn't planning on actually running any surpluses anytime soon. But what a lot of economists focus on is they focus on debt or deficit to GDP. So if you look at the deficit, it's going down to about 500 billion in nominal terms. This shows the GDP growth projections of this White House Budget Office. So they see that our current GDP will grow to above $25 trillion by 2023. And as a result, our deficit, which was in 2012 over 7% of GDP, will go down to below 2%, which would be great. However, this is reliant upon us reaching those growth levels of that 5.5 to 6%, which we have not seen in quite some time. This is social benefits. So one of the big things that outlays that I was going over, the costs of the government, is social benefits. It's a major cost, and it now accounts for 20% of our disposable income. Prior to the financial crisis, it was 15%. The problem with this is in our political system, it's very hard to cut costs. That's why they show that outlays will continue to rise. Because once you've given somebody money, it's hard to get elected if you're going to take it away. Especially, would you elect me? Hey, vote for me. I'm going to take away most of your income. So go to the, it really doesn't work that way. So these benefits are very hard to kind of remove. Especially, too, because companies and growth in the S&P is reliant upon this disposable income as a form of consumption. So I'm going to show a graph. This is since 1999. The red line is Medicare, Medicaid, and Social Security. And since 1999, it's grown at 140%. At the same time period, taxes have only grown 50%. Just below 1/3 of the growth rate of our of those social programs. At the same time, personal income really hasn't grown much as comparisons to these huge social programs as a percentage. So I'm going to talk about the unfunded liabilities. So unfunded liabilities is the fiscal gap over the next 75 years. So what is that? If we continue on our current trajectory, how much debt we must take off based on revenue projections and outlays or cost projections over the next 75 years. The CBO baseline is $54 trillion in nominal terms, which we'll have to take out. Seems very large, but again, economists, for the most part, don't worry about these nominal terms because a lot of it's dependent on debt to GDP. So if our GDP is growing at that level or above, that is all dandy. However, some economists project much greater fiscal gaps than the CBO. And I'll go into more projections later. However, I just want to point out that an average of around $75 trillion, $80 trillion of debt is a huge amount going into the future. A lot of this is because of Social Security programs and demographics. So I want to talk about calculating earnings. It's very simplified, but Ben Graham's legendary price to earnings ratio, PE formula, you use 8 and you add 2 times trailing earnings growth. However, to try to find out what your PE should be. It can be very subjective, however, because where do you get your trailing earnings growth from? Do you go back 5 years, 10 years, 20 years, and use the annualized growth from then? Especially because conditions moving forward are changing. So, as I said, it's going to be very subjective. And I want to talk about earnings. I have a spreadsheet that shows the earnings report in the S&P. So on operating earnings, which are your earnings without like a one-time expense. For example, JP Morgan in the this past fourth quarter of 2013, had a lawsuit regarding the Barry Madoff scandal. As a result of that, their operating earnings were 10 cents per share higher than the reported actual earnings, which is what they file on their financial statements. Their projection, like the market projection, was right in between. And the market didn't really know how to react that much because the reported earnings were low, but their operating earnings without that one-time expense was beat their expectations pretty much. And then actual versus estimated, pretty explanatory. Actual is what has been on financial statements, the historical data, and the estimated is what markets are looking at going forward. So the yellow outline, that's estimates. On the left side right here, these numbers are all operating earnings, these numbers are reported. So you can see that differential right there. As you see the top line for on estimates, by the fourth quarter of 2014, we expect operating earnings growth to be at $121.30 per share. Well, this is as of January 16th, the S&P projections, and as of the third quarter of 2014, because at this time only 12.9% of fourth quarter earnings had been in, we saw third quarter earnings of 2014 at $102 per share. So this is projecting over 5 quarters, 20% earnings growth. And on the two sides, this shows the annualized numbers. So this number here is the 5-year trailing earnings growth. So if you were to apply that and put your PE, it would just be a massive PE. But if you go back one more year, you only see earnings growth of around 2%. So as I said, it can be a very subjective way of calculating. Kind of, you can use a PE, whatever you kind of want to, not make up, but whatever case you want to prove, you can find a PE for it to say that it's overvalued or undervalued. So instead of talking about valuations, let's look at what's happening. So we expect 20% growth. Let's look at sales per share. This is revenue. This is top line. So how much are you taking in? This shows that over the past 8 quarters or so, revenue has barely grown, and we're kind of stalling at where we were prior to the financial crisis. And this is kind of scary because we expect continued growth, but how do you have continued growth if your sales are stagnant? Or earnings growth? Well, that's easy. Easy business. You cut your costs. You cut your costs, your operating margins go up. You're going to be able to have higher earnings numbers. We are at historical highs as far as operating margin. This is for a variety of factors. Automation, for one. You can do things cheaper with machinery. You can continue to cut costs. But however, as a substantial business plan, one of the first things that I learned was you need to spend money to make money. That's what my dad used to tell me. And right now, we're cutting our costs. We're not spending more money. We're not investing into our businesses. We're not spending more in order to gain our revenue. Our revenues are actually stagnant. So that's a concern moving forward, because if you want sustainable long-run growth, you need to grow your sales. You can't just cut your costs forever, because eventually that will just lead to the system shrinking. So this is actual earnings. I'm using operating earnings here. In the past 8 quarters, operating earnings has only increased around 10%. During the same time period, the S&P has grown at about 50%. So this shows that earnings really wasn't the main catalyst for driving growth, and that PE ratios increased by a substantial amount. And the dotted lines are projections. So after 8 quarters of 10% growth, in the next 5, we project over 20% growth for the operating earnings, while a continued trajectory of the S&P upwards. I just kind of want to focus on the top line. This is PE, price to earnings. The latest reading, this is using operated, as I talked about, operating, 12-month forward looking. So that number at the very top line, which is 121. If you use that, the PE ratio over the past year went from 12.6 to 15.4. That's over a 22% increase in a PE ratio, which is rather drastic. And another troubling remark is, if you look at the 15-year average, we're approaching that, and that includes the high PE ratios that were around during the dot-com bubble, when we projected asset prices and tech stocks to continue to rise. So that's another point to just look at as far as are we growing organically or are our expectations growing? This is a sign that our expectations of future economic growth is what's growing, not the fundamental underlying earnings growth that we'd like to see. And more importantly, sales growth, as I just talked about. So as we're looking for 20% growth, this shows reported earnings annual growth rate through the 90s. We were at like 12%. Then with a continued downward trajectory from 2006 to 2013, we've only averaged about 2%. However, again, this could be a little misleading because during the 2006 was the massive drop in earnings and we're just getting back to that point. However, this shows that we haven't really expanded much in the past since 2006. So that could also be a little trouble. So projections, I talked about projections a little earlier. This is an index. The index is the original estimate for that year. So in 1986, they projected a certain number that the S&P would be at. This shows that every line that's below, that ends below the 100 mark, shows that estimates that the final number was lower than the estimate. Any number above shows that it was higher than the estimate. This shows, again, over-optimism in projections, showing that we are being overly optimistic and that we think things are going to be better than they are. And, just fundamentally, yes, things will improve. They will improve. Just that overconfidence level. So one thing that people have been saying is share buybacks that have been pushing up stocks. I don't necessarily buy it to that much of a degree. This red line is operating earnings per share with no buybacks, and this is on a quarterly basis. The other line is operating earnings per share with, what they're at currently, and it is about a 50-cent difference per quarter, which is annualized at $2. If you put a 16 times PE ratio on that, that's around $32 in the S&P. That's really not that much. If we continue to see this trend increase, or if you see this in certain sectors or certain companies, I'd say it's something to look at. But as the market as a whole, I really don't see it as a big deal unless this trend continues moving forward and you see this widening and widening over time. So now I'm going to talk about sustainability of the economy. I just want to stop for a minute. Does anyone have any questions thus far on any terminology? All right, I'll continue. So looking at the sustainability of our economy, I'm going to go into employment situation, kind of our consumption through transfer payments, as I touched upon earlier, income inequality, which a lot of people have heard a lot about, 99%. I'll talk about how that impacts the economy as a whole, and our massive debt that we've used to fuel consumption. So U3 measure of unemployment, 6.6%, Bureau of Labor Statistics just came out with last Friday. Good news, down from 10% of our all-time highs. However, if any of you listened to Janet Yellen yesterday, even the Fed admits this is not an accurate depiction of the health of the labor market. There's other things you have to take into account because these unemployment metrics can be a little flawed. For instance, this is the U6 measure of unemployment. This includes marginally attached workers. That's those who are discouraged and aren't really actively looking for a job, even though they would love a job. And it also includes people who are employed part-time for economic reasons. So I want to get a full-time job. I want to support my family. However, I can't find one. I got laid off, but you know what? I'm going to wait tables for now because I got to make some income to feed my family, right? So this shows that we're really not at full employment, and to reset economic growth that we're relying upon, that 5.56%, we need to get it down towards this number, this 9%, which it was pre-crisis. So another factor, labor force participation rate. This includes all non-institutionalized workers. So are those institutionalized that are actively seeking for a job. So those that are under 16 don't count, and those that are retired don't count either. And this number has been dropping since 2000, largely due to demographics. We have an older population, baby boomers retiring. However, this is not a great sign for the economy. It did tick up. This last reading is up at 63 from like 62.7, but this just isn't, the kind of healthy economy that we need for this growth. And then employment population ratio. This is one of my favorite personally. This shows how many people in our population are contributing. How many workers do we have out there? And the truth is, this has been pretty steady. We were at around 63 before the crash, and afterwards we've been stagnant from around 58 to 59. This is not good because we have less people contributing towards our productivity. We have less individuals out there actually working. So this trend may continue to slope downwards as well with, again, those baby boomers retiring and demographics. Another huge factor in employment is part-time versus full-time. After the recession, we lost about 10 million full-time jobs. However, since then, we've been creeping upwards. We're at around 117, so we're only down about 5 or 6 million now full-time jobs. But a lot of people have moved on to part-time jobs. This is for a variety of reasons. We have a lot of businesses that are uncertain moving forward. There's things like Obamacare and whatnot. But the main factor is that these people aren't working full-time jobs. They don't have job security. When you don't have job security, it's hard to do things. A lot of times you're working part-time, living paycheck to paycheck. So to get this growth, again, we need to see full-time job numbers increase. Another telling tale is the median weekly earnings. That got chopped off up there. But this is a real median weekly earnings, so inflation adjusted, and the median person is actually declining. Their earnings per week is going down. There's a downward trend since the crisis, and again, when people don't work full-time, they work part-time, they generally make less money, so this makes a lot of sense. So this is a graph that shows since 2007 income increases. So where is it coming from? The yellow is that transfer payments that I was talking about, that government reliance, that money that's going to individual social benefits. The gray, the two different shades of gray, right below the yellow, are people who own things. It's rental income and business owners that are creating income via their businesses. And the black is compensation to employees. So we see that compensation to employees is rising, but it's not really as much as the gray and the yellow combined, which show that the average worker really isn't contributing, not getting that much on income anymore, and that we're heavily reliant upon our government transfers as a form of income. And that those that own something, it doesn't look like that much, but I'm going to talk a little bit later about the percentage of population that is in this gray area. So a lot of statistics can be misleading. For example, when you say your average income, but basic statistics, when you have outliers, it can make things look a lot better than they are. So this graph, let's look at the top one first. The red line is dollars of profit per employee. This starts in the 1970s, and there's corporate profits after taxes, that blue line. It shows that businesses are able to profit more off of less employees. And this is a huge factor to automation. Why would I hire a worker to sit there, an unskilled laborer, to put something on a car when I could either outsource it for cheaper, like I said, cutting costs. Firms are cutting costs. So you can outsource it or use automation. If you use automation again, however, there's less money going to the majority of people who are those workers. And the bottom shows it's pretty much the same. It's wages to profit ratio. And that again is at around just below 5, which is at really historic lows. While the profits that are going to people who own things are at all-time highs. So corporations, those who are lucky to own corporations or be stockholders or own their small business, are being profitable. So why is this concerning? Why? Because only the top 10% are really still making money. From 2000 to 2012, this is in inflation-adjusted terms, the top 10% in all these segments increased their incomes. What did the bottom 90% do? Decreased by 10%. The bottom 90% on average only makes $30,000 a year now. How are we supposed to consume all these goods that this top 10% is producing, goods and services, when they're making less money? They have less money to buy these things. As of right now, a lot of what I've shown, it's from those government transfer payments that we're reliant upon to fuel our consumption. So this shows the U.S. is compared to other countries. The left is the income I just talked about. It's net income owned by the top 10%. It's about 50% of income is made by the top 10% of our economy. That's not very good equality. But that's a social issue I won't touch upon right now. It should deserve its own time. But economically, as I talked about, you need to have your bottom percent making a certain amount of money so that you can buy your goods and services from any company or corporation. But more concerning is the wealth. The wealth owned by the top 10% of the United States is nearly 75%. That is a huge number. That means all those property owners, rental owners, all that money that I showed you back here, all that gray is just going to those people, those who own wealth, because you need wealth in order to do that. And just to touch upon something that I'm going to talk about later is savings. So who do you think saving when all the wealth is in the top 10%? Those are the people saving. Savings rate in December from the Income and Outlays report was at 3.9%. That might be a little flawed because that group of people right there, those are the ones saving. The actual bottom 50% most likely have negative saving rates because they're taking on debt and whatnot. You have a question, John?
Yeah, can you go back to that last graph? So I would argue that we're the strongest economy of those listed up there. So can you walk me through again the correlation between these numbers and the health of the economy?
Yes. Okay. So you have that huge income inequality. When you're only making things for the top percent, when all your profits from productivity is being passed on to a small number of people, their continued reliance on earnings are dependent upon people consuming their products, correct? Do you agree with that?
Sure, but why then are Spain and Italy and Japan even? I would say Japan probably.
Well, because they have a lower standard of living, their total income is less. But I'm saying that this trend is unsustainable. Yes, we're continuing to go there via cost cutting, and our GDP as a total is rising, but there's risks underlying this factor that we can't have growth continued if we don't have people to consume those goods and services, unless there's other parts of the world that people are willing to buy them, that are growing quick enough. So that's kind of the correlation, is that you need to have a thriving middle class if you want to have continued economic growth. So this is after-tax income. This might be able to play it out a little better, is that our lowest quintile, our bottom 20% of earners on average, earn $8,000 a year. But their net after-tax income is $30,000. This means 70% of their income is reliant on government transfers. So if you take away their government transfers, not only are they not going to be able to consume and pay for the goods that corporations provide, but at the same time, they might not be able to survive off $8,000 a year. So you're going to have people dying, actually. So they're stagnant on that $8,000 market income a year. The second quintile, 21 to 40% earners, are actually 30% of their income is supplemented via transfer payments as well. So a lot of their consumption, 30% of what they earn, or their net taxes, their income net of taxes, is again a lot from government transfer payments. And then finally, debt. This is our credit market debt. It's at nearing around $60 trillion. This is about over 300 times our GDP. This includes government debt, consumer debt, business debt. This number might be a little misleading because there's a lot of interbank lending that goes on. So this number might be a little high. However, that's still startling to me, a number nearing $60 trillion. I know I'm thinking in nominal terms instead of percentage of GDP. But if our GDP were to take a slip and that number were to need to grow again to fuel consumption, those ratios could get pretty lopsided very quickly.
I just have a quick question about the graph before. Where did you get where's that graph from?
This is from the IRS. It's from the 2010 tax receipts. So